Interest rates have gone up. We got headlines that they're coming down. I don't know what to make of it. Well, guess what? On this video, we're going to talk about how the interest rate changes in 2024 are going to impact you, the investor, and the bottom line of what goes in your pocket. And let me just start off, BD. I think this is one of the best times in a decade, in maybe 15 years to invest. And we're going to break that down in this video, why and what you can do to capitalize on it. BD, I want to introduce my partner. I partnered with BD on the deals. We've gotten to know each other really well. We have a lot of parallels in our messages. We serve our investors first, and we really take it to a professional level, and we're very thoughtful, very intentional about how we approach investing, investments, and mitigating risk to deliver the best products for our investors. That commonality between us drew us together, and as a result, I've become a much better, stronger investor. And I'm very happy to have my friend and partner, BD Dweik here. BD, why don't you take 60 seconds, introduce yourself to our group and to our channel, because we're going to be seeing a lot more of you here. And so, yeah, BD, please.
Yeah, no, thank you, Dr. Jonny. I appreciate the opportunity. And like I said, we met and we connected immediately because we're pretty much having the same purpose. You come from the tennis world, I come from the technology world. Just a quick background, I'm a engineer by trade, a chip design engineer. I've worked in high tech for 24 years, and I was always a real estate investor early on in my career, and I just enjoyed it. And then went full-fledged in 2019. I became job optional, started going full-time investing into real estate. And like I said, we met with you together, and we're very aligned in terms of our purpose and what our goal is, which is really invest our capital, grow our wealth, and help others in the process. Thank you, Jonny.
So BD is a tech executive, a retired tech executive that's now a full-time real estate investor, as well as an educator of children, which I love, a program that I love, that where he educates children on financial literacy and learning the things that we never learned even in dental school, right? And we got a step behind. So he's gone and taken initiatives to start teaching kids from a young age, and I think that's going to be very empowering. Now, BD, let's get into this interest rate discussion here. In order to understand where we are now, let's look at where we were. Like, let's just take a brief look at the history, and we're going to look at the timeline of where history starts as March 2022. Okay, because pre-March 2022, we had a 30-year period where interest rates, by and large, were going down and to the right. Right? Interest rates in the rich world, not just in America, but in all G7 nations, maybe G20 nations, we've seen interest rates slowly decreasing. And in Japan, we've seen negative interest rates for years. BD, let's talk a little bit about that, right? So what was the effect with a decade long, especially from 2010 down to 2022, with a brief blip with the pandemic? We've seen interest rates going down. We've seen cap rates compressing. What was the impact on real estate and investors and investments in general?
Right. Yeah, no, absolutely. I mean, just like you said, interest rate was constantly going down, going down. At one point, it was pretty much zero. It's almost like you can borrow money for free. And that lends itself well with real estate. As you know, when we buy real estate, we're buying it with leverage, right? With loans. And the bank is coming in as a partner at 70%, in terms of what they're lending. And sometimes it was 80% and so forth. So big part when we take on these real estate deals is going to depend on the interest rate. So if we look now, since March 2022, when the interest rate started hiking, the reason it started hiking is just the economy was going completely out of whack. Inflation was almost getting to the double digit. People argue how you're measuring inflation, but we're not going to get into that. But let's just say inflation was high. The Federal Reserve says, hey, I'm going to start, increasing my interest rate in order to cut down inflation. And if we look back, right now, the Federal Reserve rate, which is the rate that they give out money to the banks, to the big banks. This is not the money as you and I, as a consumer, will be able to get from mortgages or even the CMBS loans, the commercial loans. But when they started increasing the rate, between March 2022 and July 2023, they did 11 hikes on the interest rates, and those 11 hikes just shocked the whole lending system. So the capital markets pretty much got shook. Right now, it's sitting at 5.25 to 5.5%, and that's the highest it's ever been in 22 years.
Mm-hmm.
If you think about it. Now, typically, because real estate tracks a lot with lending rates. Now, if the Federal Reserve rate is sitting at a 5.5, the lending rates are typically about 250 basis point, or to make it simple, 2.5% above that. So if you're sitting at a federal rate of 5.5, you add 2.5%, that's really where things are in terms of actually borrowing. And that's making it really challenging for a lot of real estate to actually make sense in terms of penciling out. Because now if 70% of my money that I'm going to put in to purchase that property is going to come from lending at 7%, I can no longer buy a property, at a cap 4.5 or a cap 5, because now I'm in the negative leverage. So since March 2022 until I'm going to say mid-July, just through the hikes in the interest rates from the Federal Reserve, a lot of uncertainty in the lending market, and that actually put a lot of pressure on a lot of these commercial properties, and that tend to relate with interest rates, where the cap rates on those started going up, so started deflating or decompressing, which means now with the same amount of income, the property is worth a lot less, which is wow. Now actually it's almost like everything from a real estate standpoint is on discount, and as that rate from the Federal Reserve starts to go down, which is probably the next part we're going to talk about, there's definitely an interesting play there, as a real estate investors that's worthwhile talking about to go capital.
Yeah, before you get into that, let's unpack a little bit about what you said there. I mean, you made some very, very interesting points. So pre-March 2022, we saw interest rates going down, right? When interest rates going down, the cost of borrowing money gets less. So what do people do? They spend more to buy property, right? So we see cap rates also compressing, like you said. So the values have gone to almost a peak. On top of that, because of the pandemic, they gave us tons of stimulus money, right? And for the first time in US history, the federal government directly put money into people's accounts, whereas before it was put into banks and then it filtered down through loans and stuff like that to the people. But now we had direct deposits to people. So now people are flush with cash. The cost of borrowing is zero, and cap rates get compressed all the way down, and people pay inflated price, and real estate values shot up, right? And like you're saying, BD, the values of real estate, especially American real estate, it's based almost completely on interest rates, right? Like the values go up. When interest rates go up, values go down. When interest rates go down, values go up, because people are willing to pay more for money because it's debt serviced. It's a debt-based, it's a credit-based system. So now, BD, the prices went all the way till they got scorching hot. People are flush with cash. Inflation was, I think, even greater than what you were stating, what the official numbers are, because if groceries have gone up 50%, what they're telling us that interest, bag of groceries at Whole Foods. I used to be able to go on, if you go into Whole Foods right now with $100 to just, you pick up just a couple of items and it's automatically $100, right? Like back in the day, my mom used to go grocery shopping for $100. You came back with 3-4 bags of grocery. Now you're getting a small half bag of grocery for $100, right? The cost of gas, and I know they strip out food and energy from inflation, but it's not really fair to do that. But that's another topic. So inflation was crazy. And then you said they started rate hikes. They want to calm inflation down. So we're going to boost up the interest rates. And they did what you said, the fastest rate hikes in 40 years, right? Something like that. So from March 22 to mid-June.
July. Yeah.
July of 2023, we had consistent rate hikes where the interest rates went up, right? And what BD was talking about is the index rate and then a spread that the bank will put on so that they can make money. So now it went from 0, and the federal fund rates went up to 5%, right? From almost 0 to 5. Now all of a sudden we can't borrow money anymore, and the cost of borrowing money goes up. We can't afford to overpay for real estate anymore. We can't afford to pay these compressed cap rates, because if we're borrowing money, we got to borrow money for more than this property is making. So it doesn't make any sense. So what happened is we started seeing cap rates when interest rates expand, we see cap rates following, right? So cap rates started expanding. When cap rates expand, the values of real estate start going down. But now, BD, when this happens, what also happens is you get negative sentiment from investors, period, right? Oh, they read the articles. We're headed for recession. We're headed for downtimes. America's in trouble. And investors also, the negative sentiment also picks up. And I think that adds to it too, right, BD? I mean, the fact that real estate now has gone down in value. These sellers, especially the stuff that we look at, they're like, hey, look, just 12 months ago, you were offering me $5 million more for this property. This property's income's gone up in that time, and you're offering me less money for it now. And sellers were like, if they weren't in a position they had to sell, they were like, hell no, I'm not selling at this price. I'm going to wait till interest rates come down. I can afford to sit on this cash flow and I don't need to sell it. I'm not going to sell it to you guys at this time. And so what happens is now sales volume dropped off completely, right? Everyone stopped doing business. Banks, when those interest rates are going up, BD, banks stopped lending, right? Bridge loans and stuff disappeared because banks were like, I'm scared too. I'm not lending money in this environment. I'm not getting stuck and caught with a falling knife here. I'm not trying to catch a falling knife. So all of a sudden liquidity dries up, buyers dry up, sellers dry up, and there's no activity. But then we talked about distressed sellers, but there are still always people that need to transact in the marketplace, right? So even if it's bad time, and especially if you get caught up in this interest rate hikes. So now we talk about this before on this channel, BD. We've talked about this all the time. This because these are the type of deals that people like me and BD are looking for. We're looking for these type of people that have to sell. Hey, the mortgage rates doubled or tripled on us. We can't afford to even stay in this deal anymore. We have to unload it, and we have to unload it now. But the thing is, there's nobody out there buying. There's nobody out there lending. So now the people that have the 2 C's, I call it, cash and courage, have the ability to capitalize on this. And we've been doing it. Let's talk about, the deal that we just did in December. I mean, what we're talking about right now with the distress, because due to interest rates, all this stuff that happened, we're not just talking about, we're actually doing it, right? We did 2 excellent deals that we were able to buy from truly distressed sellers. Let's talk a little bit about the deal that we got into and why it was just the timing of the market that made it so attractive.
Yeah, no, absolutely, Johnny. And it's like as a real estate investors, you really need to know when to buy and you really need to know when to sell. And I know it might sound very simple, buy low, sell high. But the sentiment in the market's typically not that. You speak to other people, they're like, everybody running to the hills. Just maybe a quick side note, where I really made a lot of my money in real estate was in 09 and 10. Everybody was running away and I was buying short sales. And I was a guy working full-time in tech. But I was like, hey, I'm going to do opposite what everybody is. Everybody's like, oh, no, don't buy real estate. It's going down. When I started looking at cost bases, where this real estate was, where it is right now, and this is back in 2009, 2010, I was like, I cannot not buy it, especially in the Bay Area where I live. It's like, it was just an unbelievable offer. And the same thing is happening right now in commercial real estate. I've been invested in commercial real estate for quite some time. And the deals that we saw in the back end of 2023, when interest rates stopped hiking, it's already hiked. There's a distress. There's a lot of sellers that have to sell because their interest rates went up. They can't afford the payments. It created a huge buying opportunity. And, we worked together on 2 deals where we basically got it at a 30% discount. So imagine you're walking into the store, the outfit or whatever you want to buy from that store is a 30% discount. That's really what it is, because money's made on the buy. Money's made on the buy. And we're able to kind of buy both of those deals at an incredible discount from what they were trading about just 2 years ago or 3 years ago.
And
so believe it or not,
just to add to what you're saying, when we're talking about 30% discount, we're not talking about a 30% discount at Kmart and JCPenney's. We're talking about 30% discounts at Louis Vuitton, Hermes, and Gucci, and they don't have sales. They don't do sales.
No, these are institutional class assets that are really hard
in
to
the prime
find
markets, right?
In Dallas, Fort Worth, for example, one of them
which
2
might be the
years
number 1
ago,
or number 2 best market in the entire country, right?
yeah, when you look at the actual economics, it's probably one of the best growing cities right now that has the job fundamental, that has the income growth, the rent growth, and everything else. And the best part about these particular properties is, like you said, it was the Hermes or the the institutional class asset is just the buyer that bought them at $180,000 a door is in distress, and we're able to pick them up at $120,000 and $130,000 a door, and that's unheard of. I mean, this is like 5-year ago type pricing, and all of that is due to interest rates. So in some sense, it is causing distress and heartache for some people, but for buyers that really understand real estate, for buyers that really understand how to trade it, how to buy low and sell high, they think of this as an incredible opportunity. Because yeah, even though debt is more expensive right now, but hey, if I can get it into the property at a big discount right now, interest rates is going to start coming down. I can refinance out of it. I can go figure out different type of loan I can put on this particular property. On the exit, on the way out, what I expect is as interest rates going to start going down, cap rate's going to start going down. Effectively, now I'm going to have a higher multiple on my exit. I'm going to have a higher multiple in income. So I'm buying a property for a 30% discount based on its current income. I'm going to continue to improve its income, and then I'm going to go back and sell it or trade it at a much higher multiple. So, that's really how money is made. And this is definitely a very rare opportunity. It doesn't happen often, especially in commercial real estate. It's different than a residential market, but in commercial real estate for these type of class of assets, like the one we did in December, it's just an unbelievable buy, and it's just hard to find these type of buys.
Yeah, there's a saying Mark Twain says, history doesn't repeat itself, but it often does rhyme. Let's draw parallels to 2009, 2010. You said you made most of your money in 2009, 2010. A lot of people will look back and say, oh, well, that doesn't count. Everybody made money. You could buy stuff for dirt cheap that time, and everybody could make money. But guess what? The headlines at that time were, the sky is falling. This is the global financial system is going to be wiped out. America's financial system is going to end. End of the world stuff. If you go look at the articles, this is what people were talking about. And so it was not easy to go out and invest, because you would be going against everybody else, because the grain was, you're going against the grain, right? BD had the foresight to realize that there was a huge opportunity. And it's very difficult to see that opportunity when you're in the war, right? When you're going through that war, it's very difficult. Looking back in retrospect, saying, hey, look, hey, in Phoenix, we were able to buy houses for 50 grand, right? And nobody wanted to touch all those houses in Phoenix. Nobody wanted to touch all those subdivisions of foreclosed houses in Las Vegas. Nobody wanted to even touch it. But then you see, I heard on a podcast the other day, BD, a couple came from Australia, and they spent $5 million in a weekend, and they went and bought 300 houses in Phoenix. And they made an absolute fortune when the things turned around, because they're buying houses for $20,000, $30,000, $50,000. And these houses are now worth $250,000 to $300,000, right? And so that's the same, very similar type of situation now, right? It's not the same thing. The housing market didn't crash. Here we have a completely different situation. Housing is at all-time highs, but the sentiments are very similar, right? Everyone's like talking about, oh, this big bubble in commercial real estate. There's a $1.5 trillion of floating rate debt coming due. Yes, all of these things may be true, but if you can learn that the fundamentals are there, like almost every distress in real estate is caused by interest rates, right? 2008, 2009 was interest rate. It was debt related. Here again, it's debt related. And I mean, you talked about this already, but why is 2024 and probably 2025 a time for fortunes to be made in real estate investing?
And like I said, it's really the tracking of where the Federal Reserve rate is going to be. Right now, we know that it already went in, all the way up in terms of the hike. They're starting to get inflation under control. Inflation is sitting right now, above 3.25. The Federal Reserve is going to announce, I think March 19th is the next announcement. And the expectation is either they're going to keep it flat, continue to keep it flat, or slowly start to decline it. And what that would do over time is it would start moving the capital markets or the lending markets, saying, oh, okay, now interest rates are starting to go down. We need to start processing more loans. We need to make it a little bit more interesting for commercial real estate investors to actually buy more products. And that's really going to drive the sentiment. But I want to kind of go back and touch on the comment that you said about distress in commercial real estate. It's actually, distress is great. If you're an investor and you're in the buying mode, you want to see distress. You want to be, because that's really how you'll be able to get the 30% discounts, is a deal goes sideways because they have a floating rate loan and they're in distress. It gives you the opportunity to buy at a rate. So from my standpoint, this is when I want to move in. I want to move in big. And that's why, for example, the first half of last year, we didn't do any multifamily deals. The second half of last year, when interest rates stopped going up and there was a distress in the market, that's when we went in big and heavy. We went in 4 different deals in Dallas, 2 of them with you. But like I said, because we were really bullish on the acquisition makes sense from a cost basis. We know that 3 years out in time, these things are going to have a much, much higher value. And the reason they're going to have a much higher value is now interest rate starts to drop. With that, we expect cap rates to slowly start to actually compress again. So now if we bought $100,000 income, at a cap 6, which is a 12x multiple, now on the exit, we might be able to have the cap rates compressed to a 5.5 or a 5. So now it becomes a 20x multiple. So imagine like you're buying a business, probably a lot of your audience is dentists. Imagine you're buying a business at a 12x multiple. And let's just say you keep the income flat, and then due to market changes, you can go sell it at 20x multiple. That's really how money's made. And that's why interest rates and cap rates, especially in commercial real estate, is really the foundation. If you're a seasoned investor and you know how to invest and you know how to buy properties, you can use it to your advantage. So really the time is now to really kind of go capitalize on that interest rates already gone up, and now it's on its way to start going down. There's distress opportunity. That's really where you can get the discount on the buy. You can walk in and get a 30% coupon discount on the purchases. And as the interest rate starts to drop, guess what? Cap rate is going to start to compress. Valuation is going to start shooting up. So when you start exiting these deals that you're buying now in 2023, somewhere in the 2026 timeframe, you're going to expect to get a much higher multiple on those from an income standpoint. So that's why there's a great opportunity right now that I'm super bullish about it. And I know you are as well, John.
Yeah, very well said. Very well said. So again, like, just to kind of summarize what BD said very eloquently is, hey, look, prices have come down. We have ability to buy really top class, high quality assets at temporarily undervalued prices, right? Recognizing that the value is based on cap rates and interest rates, and having knowledge that, hey, look, cap rates are kind of maxed out now. Interest rates have maxed out, and they're going to start lowering interest rates. Cap rates start to follow interest rates, and the same property for the same income, even if you haven't improved the property, just based on the cap rates starting to compress, you're going to start to see the returns and the value of that property start to go up. And that's where the fortunes are made, right? The fortune is made on the buy. That's where the profits are made on the buy, right? So if you can buy at great basis, you can buy great assets in great markets with great operators that can navigate through the present storm, if you want to call it that, because on the other side of that storm is a beautiful and bountiful place, right? So that's why this is a time where me and BD are very excited. And we're very excited to do as many these type of deals as possible. I also, BD, didn't do any deals in the first 6 months of the year of 2023 because I don't have to go out and do deals. I only want to cherry pick the very best ones that fit our criteria and truly make me excited, right? And these are the type of deals that I want to bring to investors. But now it's like a kid in a candy store as an investor because, hey, look, we know that this is the time to go out and invest and find great deals because there's just a lot of them out there, right? We're going to talk on another video, we can talk about how we've gone from not having enough deals in the pipeline, at least for me, and not having enough deals in the pipeline to having access to tons of deals in the pipeline, how we filter it, how we figure out which are the ones that we move forward with. That's obviously a topic for another day. So looking to land the plane here a little bit on this video. I think this is a great video so far, BD. And thanks for joining so far. So we've kind of summarized, we've talked about where interest rates were, how values got to where they were. We've talked about the interest rates hikes, the impacts that it's had on the value of real estate. And now we've talked about what's happening now and with interest rates coming down and how it can impact us in a very beneficial way, a very lucrative way, if we're able to understand and learn these fundamentals and apply them when we're investing. BD, I want you to just give us some final words, some final thoughts on this subject matter. Then we'll wrap this one up in a bow, and we'll submit it to our YouTube University and get ready for our next video.
Awesome, Dr. Johnny. Yeah, no, for sure. I'm quite bullish, and like I said, great opportunities are being presented. And really it's about us as investors, as savvy investors, knowing when to take action, how to capitalize on these deals as they come in. I turn off all the media, all the stuff on the news, because frankly, it just like, it's always after the fact. And frankly, I'm bullish as ever right now. I've, used to invest, alongside my investors, 50K per deal. In the last few deals last year, they were so good. I was actually doubling, what I'm investing on a per deal basis, because I'm extremely bullish on these type of deals. So like I said, great. We're coming in at a great cost basis, 30% discount. A lot of the deals that are being structured with fixed rate, which means we're not going to have a distress in terms of an interest rate. They're using all sorts of different new debt vehicles with cap rates and so forth. And we're just going to leverage, or basically going to take whatever we do, which is invest in great properties that were bought at great value with great operators, and get an extra amplifier as the market compresses the cap rates. The Feds are projecting to drop the interest rates right now from 5.5 to about 4.6. which you know that the cap rates are going to follow in terms of compression. So naturally, not only that we're acquiring great properties at a discount, they're going to be operated well, there's a potential to increase the value, but the cap rates, the market itself is going to actually even help us further, which is going to amplify our return. So that's really what I'm very bullish and I'm very excited about that. And I appreciate, you know, as you and I discussed this, we're both pretty much speaking the same thing and say, hey, let's record a video on this and try to educate more people, because the more people understand this, the more they'll get bullish and they see the picture that you and I are actually seeing.
Value, yeah, I understand. Yeah, very well said. BD, for the listeners that want to learn more about you and how to get in contact with you, you know, please share that as well. We're going to share it in the description below, but you know, what's the best way to reach out to you?
I'm on LinkedIn. You know, you can see my name, Dweik, and our group is called Bluestone Flagship Investors. Again, we're doing the same thing like Jonny, trying to find great deals, work with investors, like-minded investors, and invest alongside us. So again, we welcome anybody from the listener reaching out, you know, whether it's for us or whether for Jonny. I think we're both working for the same cause, pretty much, you know, aligned interest, aligned in the deals. And you know what? Now the best part is we're even tackling deals as a group and being able to negotiate much better returns. So as you know, as we've experienced it last year, we're very bullish in terms of working together. You know, you have your network in the dental group, I have my network in the technology group, and like I said, our interests are aligned. We want to be able to acquire and invest alongside each other with our own investor groups into great deals and really capitalize on this market opportunity that doesn't happen very often.
Very good. Thank you, BD. All right, guys. So hope you thoroughly enjoyed this video. If you did, drop a fire emoji on the comments below. My man BD, he did an absolutely excellent. He did an absolutely excellent job. Round of applause for him. I hope you enjoyed this video, and click on the next video for more wealth building tips to keep your bank accounts growing and your abundance flowing. I'm Dr. Jonny Walker. I'll see you next video.